Hello.
Hello, Professor.
No. So I think that most of you already joined, so there is no other reason to wait for others, so they can join us later. So the last time I asked you to do the activity and submit it on Moodle, which you did it and upload it. However, what I realized from the Moodle, that not all of you participate in these activities. As I told you at the beginning, that these activities will be graded. You will get points for it, okay? You'll get the points for it. Just do not take it easy. Like if I not submit, like nothing will happen. Of course, you will not get the full mark. As I told you, the activity part is 10%. So you have to fill all the activities. At the end of the semester, I will count them and you'll get 10%. So this 10% is really playing a significant role. And plus, I might give you some bonus activities to improve your grade if you will need it, of course. And this is very important. Just want you to pay attention for it again. Do not take it like, okay, if I don't submit it, there's nothing can happen. Okay, today we're going to continue with our lecturing. It's a replacement project analysis we just covered, and there's one example. Just I want to go quickly over it. Then I will move to a new chapter. So that example is given on the book. It's given on the book. Okay, it's with the replacement project. So we are given the replacement project, okay, with the old equipment and the new equipment. Here, this is all the equipment that we have it. So the current book value is 400,000. Current market value is 600,000. So remaining life 10 years, and annual sales is 300,000. Cash operating expense is 120. Annual depreciation is 40,000 for the remaining value, and accounting salvage value is 0. And expected salvage value at the end of the 10th year will be 100,000. Acquisition cost of the new equipment will be 1 million. Life of the new equipment is 10 years. Annual sale 450. Cash operation expense is 150,000. Annual depreciation is 100,000. And expected salvage value is 200,000. So if you remember how we used to calculate the investment cost, we used to calculate fixed capital investment plus net working capital. If anything you sold, let's say, and is anything so. In the previous example, the example from the slides, our market value, our salvage value was less than book value, but in here it's just vice versa. So as you can see here, that the acquisition cost, net working capital, and 600,000 we are selling it the old equipment for. So 30% is the tax rate. So as we can see that the salvage value is greater than the book value, that means there is a 200,000 difference. So these 200,000 will be the gain on which we're going to pay the tax. So in this way, we get $540,000 as a total cost. And the cash flow is calculated in the following way: change in sale, change in cost, change in depreciation. You derive the EBIT, then you add the depreciation back. So if we can go to the Excel file, let me just download it from here. So for 10 years, okay, my initial investment outlay, as we did it, okay. As you can see, the tax rate is this much, and how much you paid in terms of tax amount on the gain. And the sales is the difference between the old and the new equipment. So as you can see, the sales of old equipment is 300 and the new equipment is 450. So 450 minus 300 will give you 150. Okay, this much we get it, like new minus old. This is new, this is old. And then cash operation expense, 150 minus 120, which is 30. So if we could get here a negative number, that would mean definitely we are saving the money. But in here we get a normal positive number of cash operating expense, which means that there is a cost. So acquiring a new equipment brings you more cost. However, our concern is not the cost, but our concern is improving the sales. And depreciation of the old one is 40,000 and new one is 100,000. New and old. And we just recalculate depreciation and we get 60,000, like 100 minus 40. And earnings before tax is 150 minus 30 minus 60. So this will give you 60,000 of earnings before tax. Then we arrange the tax, which is 30%. And operating cash flow after tax is equal to 42,000. Then we are adding back the depreciation to get operating cash flow after tax. This is what we get it, okay, for all years. Then we just put it down to estimate the cash flow for MPV. So we're just getting down this all. And the last part, which is terminal non-operating cash flow, this is, okay. So this is expected salvage value. So if you go back to the question, it says, look here, expected salvage value for the old equipment is 100, for the new equipment is this. So if you see the formula, let me just put it here. Okay, here's the formula. So salvage value plus net working capital and the tax on the gain. However, salvage value minus book value. However, we have a replacement, which means that we need to take the differences between old and the new. So salvage value of old, new minus old, new minus old. Net working capital is same. So 200 minus 100,000. Net working capital and the salvage value and the book value. Salvage value of the new. This is like new, and this the same should be for old. Okay, the same we should have for old, and this is 1. And whatever you get it here, it should be negative. So it should be taxed and subtracted or added to the investment, to the terminal and operating cash flow, whatever the results we get it. Okay, just a second.
So we should make it separately, yeah? For the new one and for the old one.
Yeah, very true. Now, if you see the formula, 200,000 is the new equipment salvage value expected. 100,000 it's old equipment salvage value. Let me just bring it here to show it to you. So this 200,000 is this. 100,000 tax rate, and the issue in here, 200,000 minus 100,000. The book value end of the year, will be equal to 0 in both projects, because they're both straight line depreciation 0. So which means if you apply the formula of replacement cost, like you should get it in this way. Let me just type it. So my terminal non-operating cash flow is equal to salvage value and of new and the old one salvage value of new minus salvage value of old equipment plus net working capital and minus tax. Let me put it this bracket. So in here, salvage value new minus book value new minus salvage value old minus book value old. End of the year, guys. This is the end of the year of project. In both cases, the book value will be equal to 0, because in both cases our depreciations are equal to the straight line methodology, and as you can see there, the book value is not given at the end of the year. But in here, current book value 400,000, but still we have 10 years. After the 10 years, what will happen to this book value if annual depreciation is 40,000? So 10 years, and each year, for 10 years, we have $400,000. But for 1 year, we spent 40,000 of our equipment. So in 10 years, will we be able to spend all of the value of our equipment? If you divide just 400 by 40, you will see that it's equal to 10. So at the end of the 10th year, the book value will be 0. The same thing with the new equipment. So the book value in this formula is equal to 0, 0. So that's why if you calculate it, terminal non-operating cash flow, then it will be 200,000 minus 100. This is old, new minus old, plus net working capital, which is 80,000, minus the tax, which is 0.30, and the brackets in here you find it 200 minus 0. You close the bracket here, minus 100,000 minus 0.
Excuse me, Professor, can I ask?
Yeah, sure, of course, you have to ask.
Can you express one more time why it's 0?
Because look, you buy the new equipment. For how many years you're going to use the new equipment?
For 10 years.
For 10 years. At the end of the year, so each year, what will be the depreciation of the new equipment? Annual depreciation, it's here, 100,000. Okay, for 10 years, it means we will use of the whole price, the whole cost. At the end of the year of the 10, so 10th year, it's the end of the project. After 10 years, the book value of this equipment will be equal to
400,000?
No, new equipment.
New
0.
equipment.
0. Why 0? Because look, if it was here 1 million,
Because for 1 million, and then by every year it decreases by 100,000. And
very good, very good.
Okay. Yeah, I got it. Yeah.
Okay, so at the end of the 10th year, we will use the last 100,000. So at the beginning of the 11th year, the book value, or end of the 10th year, it will be 0, the book value, because we used all. So the machine or equipment is not usable at all.
Okay, thank you, I got it.
Okay. So this is how we get the book value, the terminal non-operating cash flow. Then this terminal non-operating cash flow is added to the cash flow after the tax. So once we did it, the time to come to estimate the NPV, we are applying the function of the NPV in Excel. which is 8% and so on, plus this blah blah, and we get it positive number. So we do accept the project. So we do take the decision in a positive way, which means that we will replace the old equipment with the new equipment because NPV is positive. So it's worth to change the old equipment with the new equipment. But if you compare your decision with the slides example, there we had a negative NPV, which showed that it's better not to replace it. And now we get a support from IRR as well. We can see that IRR is greater than cost of capital. And we just say we do accept our project. So our project is feasible. This is the book example. This calculation is available online on Excel and uploaded on Moodle. You can access it and check again from the book. Just wanted to illustrate this one again. So if you have any questions, please ask. If you don't, let me move further.
Sorry.
Yes, please.
Where do we get our 500?
This 540,000? It's
Yeah,
our investment
yes.
cost. It's our investment cost.
Okay.
It's our investment
Thank
cost.
you.
You're welcome. How do we calculate? I showed you last time. It's here as well. Like fixed capital investment, like buying the new equipment, net working capital, selling the old equipment, plus tax amounts on the gain. And the gain between the salvage value of the old equipment minus book value of old equipment.
Excuse me, sir.
Yes, please.
Can you hear me?
Yes, I can.
Could you go back to Excel, please?
Yes, sure.
I have a little bit silly question. Sales is equal to 150,000.
Yes.
How could you recount it? 450,000.
Wait a second. Wait a second.
Okay. Okay. We just take a difference between the new equipment and old equipment sales, right?
Very true. Very
Okay.
true.
It makes sense. And 30,000, it's fixed cash operating expense, right?
Yes, the difference between this and this. New minus old.
Okay. The difference. Okay. Okay. Great. Thank you.
You're welcome. Any other questions? Okay, if you don't have any questions, then let me just close this one and move whatever I did not cover. So in here, we get the negative number in the slides, and this IRR is less than the required rate of return, which shows that we should not accept the project. We should not replace the old copy with the new one. And let's talk about how the inflation affects the capital budgeting analysis. So analyzing the nominal and the real cash flows, nominal cash flow reflects the impact of the inflation, while when you take the real cash flows, which are adjusted to downward to remove the inflation effect. So nominal cash flows should be discounted at nominal discount rate, while the real cash flow should be discounted at real discount rate. But in our case, in our class, we will not apply the inflation effect, but it should be, but we're not going to go through it. Changes in inflation will affect the profitability, and inflation reduces the tax saving from depreciation as well. So how the inflation decrease the value of the payment to the bondholders, another story, because the value of the money that you hold it now, it will not be equal to the value of the money that you will have it on the future. So the bondholders, those creditors that they are expecting to receive some money in the future, if there's a high inflation, they will not get anything worth that they could get it today. So inflation may affect the revenues and the cost differently as well. This thing that we should take it into consideration when we are involved in a real project. So project analysis and evaluation. What if we are choosing among the mutually exclusive project and that have got different useful lives? So we have two projects and only one project should be chosen, and they have got a different life. then we need to do something. We need to adjust to our decision. And what happens under the capital rationing? So there's some decisions should be taken in accordance with your budget. You should come up with a rational decision. And how do we deal with the risk then? So mutually exclusive projects with unequal life, when comparing projects that have got different useful lives, we cannot simply compare the MPVs because the timing replacing the project would be totally different. Therefore, the number of the replacements between the projects would be different in order to get the same function action. So the approaches that are used to solve this issue when two mutually exclusive projects have got different useful life. The first one, we use the least common multiple lives approach. The other one is EAA, which is equivalent annual annuity. So I will share with you one example. Consider two projects, G and H, both with a required rate of return 5%. One project will last for 4 years, the other one will last for 3 years. And MPV estimated for both projects are illustrated in here. If you didn't have any information regarding when the projects are having different useful life, then you cannot make a decision on selecting according to MPV, then you would just select the highest MPV. This would be your decision. However, we need to just make some adjustments in here to replace actually, the least common multiple lives approach is the method of replacement. How it works, I will illustrate in Excel. So we need, when you do replacements, it will help you to equalize the useful life of the projects. Then it could be easy for you to select which project to select and whether it's acceptable or not. In here, we are given a bit different way of calculation, but I want to illustrate the way that I'm doing it. So in here, they're doing that project G. This project G has got 2 replacements, and project H has got 3 replacements. So we should find the one common number, the division number, mainly, that could be divided, like 3 and 4. What is the common number that comes into your mind? 12. So we need to increase both projects until the 12th year. So let me just. Okay. So project H and G. G has got 2 replacements. H has got 3 replacements. So what I do, by calling replacement, I mean how many times you will repeat your project. So when you, until you reach 12 years. So I just copy and paste. Copy and paste, copy and paste. No, it didn't work here because it's. Just a second. 1, 2. Now, what I do here, first of all,
I have a question.
$40.
Yeah.
In the
I
first
think
year.
it should be 40.
sorry,
Third.
Project H, you forgot $40.
wait, I didn't forget it. I didn't forget it yet. I didn't come to it. Just a second. I just replaced 40 with 100. End of the 3rd year for project H, it is the beginning of the new project. So, which means that 40 minus 100. So the $40 I received from the 3rd year project, at the same time, I'm starting the project again in this year. Okay, same thing here. Same thing here. So in here, as I didn't just calculate it, just to show it to you. So I do the same thing for project G.
So why we should do it again? Like what we have done?
Because we are equalize. What if the idea is that least common approach is telling you you have to replace every year until you reach the common number of the years for both projects. We said it's a 12 years. So for the 12 years, within the 12 years, how many times you can run the project H?
No, I mean, why this project can be repeated this 3 times, 4 times? I mean,
I mean, in order to compare which project is give you more benefits. So you cannot compare project, you cannot say, according to this, project H is better or G is better. You cannot say it. You need to equalize the number of the years, the useful life of the project, the life of the
That's why we
project.
should repeat it and repeat it again, yeah?
Yes,
Like
for example,
during the
I get
12
my
years.
benefits. So how it works, let me show in slides in here. So project H, as you can see here, I did it 3 years, I got my NPV. Okay, got my NPV. Then I start this project again. I get the second NPV from this project. And then I move third time. So I repeated this project 3 times. And I get my NPV. And at last, I just sum it up and come up with certain number. Okay, I did my NPV. And project G, same. I get my NPV, get my NPV. I'm just repeating. First project finished in here. I got my NPV. Then it's again from here, 4 years past, finish. I got my money back. So you have money, let's say, okay, you've got money. If you come back to the here, you have $100,000, okay, $100,000. So 3 years passed, 3 years passed of this project, you invested 100 and you earn this money. Then again, you reinvest $100 because you know how it works. You reinvest again, it works, you earn your money again. You reinvest again, it works, you earn your money again. And you do it until you reach the common number of division of 2 projects in order to compare which project would be more beneficial to you.
but it's limited by time. I mean, for example, during 4 years, it would be project G better. Oh, if
That's
it's
why we need,
limited by 4 years, only 4 years, for example.
that's why we
No.
need common denominator.
Yeah, that's what the reason we cannot say that the project G is greater than project H because it gives you more cash flow. You cannot say this because we need to compare the ages of the project. As you can see, in 3 years, this project is performing well. If you compare only 3 years, it has got higher cash flows. However, in the 4th year of the project G, there is a $30. So it makes a bit, so it puts you in a position that you need to apply least common approach that will help you to analyze what you're gonna get it if you do it both project in the same years by replacement. So, but it doesn't necessarily mean that you will do it like replace it every year, every 3 years, every 3 years. So it just gives you the idea which project to choose. Project H or project G. Am I clear? I don't know. We
Yes.
have to see. We cannot say now because I need to see the cumulative NPV, how it works. Then I would be able to answer which project is. So in here, Okay. This is my NPV for H. Now I will do the same thing for
Excuse me, could you click on the NPV formula for any of the projects?
yeah, surely. I'm gonna click it. Don't worry about it. It's just a normal function. I'm taking the first investment cost subtraction from the NPV. Okay, I think it matched. Just a second. Okay. Let me make it smaller. Can you see it now?
Yes, it's perfect. Thank you.
And same thing in here. So our decision in here is to accept the project H. So the project H seems more prior to G. Okay, I got some example from the book as well. Okay, I got the example from the book. So this project S and L, same, but we have 3 years, 3 and 2 years. What is the common number of division? 3 and 2?
6.
6. So until the 6 years, we need to repeat the process by replacement. I will take this and replace it like 160, 10. So 90 minus 100. That's why we have 10 here and here. So in here, in project S, we will do 2 replacements. And in project L, we will make only 1 replacement. That would give me NPV of project S higher than project L. So my decision to accept project S. So when you are doing it this, okay, imagine you have 2 different projects. It's expansion, if it's a replacement, you do all your cash flow estimation, cash flow projections, and at the end, let's say this is NPV, okay? This is NPV for 10 years. Now NPV for 5 years. Okay. What is the common division for 5 and 10?
2.
Yes, 10. So you have to do 2 replacement in here and not 1 replacement in here. That's it. And you can see what will be the NPV. Comparing this with this. And to choose which project is more profitable. However, you can see it which NPV, but in here you directly reject the NPV. You don't do anything here actually. Okay, do you have any questions up to now?
No.
Okay, it seems like very clear and just easy to calculate. So project H, using the
One quick question. What if
please.
the project, sir,
Yes,
sorry, is there any difference if we're comparing the projects and they have different, one is using Macker's accelerated depreciation and one is using straight line depreciation?
yeah, of course you don't know in here we don't know the NPVs, how they are derived. It could be getting through the Macker's, it could be getting through the straight line. So we should check the cash flow projections.
And if they're, for example, one is made with Macker's and the other one with straight line, then we should adjust them to both Macker's or both?
No, it doesn't matter. You have to see the decision why and reason why it has been used like this. Because
Okay.
because the project could be from the different countries. One in
Okay,
US, the other one in Euro.
I see. Thank you.
Okay. Okay, coming to equivalent annual annuity, we're just calculating for the payment, for annual payments. Which one gives you the higher payments? That would be the actually a choice to go with that project. Now, we are using the same projects, okay, here, same project. We calculated NPV, and we know the number of the years are different, but to see which one will give you higher annuity, you will go with that. So my present value is this one, my NPV, my present value of cash flows is here, subtracted to investment cost. The maturity is 3 and 4 years. The rate is 5%, okay? And now we can calculate equal annuity return. We can see that 2.25 is higher than 1.80. So we choose project H. So when we did least common wealth approach, we selected project H as well. And we select in here as well, calculating the annuity. And I'll show you the function, how to calculate the annuity in Excel function as well. It's just a payment, but put the negative number, because when you calculate the payment with a present value, it just calculates directly, gives you the negative number. If you can see here, okay? It's just matter of the Excel function, nothing to do with calculations itself. So first, you put the rate, 5%. Second, you put the number of the period, which is 3. Let me just repeat it. So PMT, open the bracket, put the rate, 5%, put the present value, put the number of the periods, put the present value. You can put the negative sign in here. If I'm not mistaken, it should give me, yes. And PMT for this, or we can do like this. 1.80, directly it calculates everything. So our decision to select project H. Do you have questions? Do you want me to repeat it again? This is the easiest one.
Yeah.
Please do not hesitate to ask.
Could you please repeat it again, just to make sure?
Okay. Now, I just put this down, maturity, present value, and the rates, they're all given. Then I calculate payments, PMT. I open the bracket, rate, number of the periods, and present value amount, or NPV. I close the bracket and press enter.
And should we put the minus sign before?
Why minus?
Because in Excel function, it accepts the present value as a negative number. So in order to have the regular number in here, I should just treat it in this way. If I don't put this minus, I will get negative number. So whenever you calculate the present value annuity,
What does EAA stands for?
equivalent annual annuity, like the annual annuity you get every year. Not every year, every period. Okay, my question. Is it always, what do you think? Is it always the case that the result with equivalent annual annuity is matched with least common multiple leaves approach? Did you get my question?
One more
Could you
time.
repeat the question?
Is it the case that results of equivalent annual annuity is always supporting the result of least common multiple leaves approach?
No.
So we
Well-
can see here. Okay. This could be a good investigation for you. If you have answer now, tell me now why. If not, research it and come to the class with this research next time, and you get your bonuses for this. Or we can do it in this way. We've got, I wanted to give you activity as well. Plus answer this question, writing your answer to activity as well. Okay, so the activity I want to give you. So I will select, let's say, 2 projects. It will be A and project B. But not now, I have to finish something. I'll come to this activity. There's something left that I need to go with. And let it make it like this. Okay, which project would you select? I will come to this. But before then, I would like to just finish whatever I just started. So decision making under capital rationing. When there is a capital rationing, the company may not be able to invest in all profitable projects. So the key decision I'm making the under capital rationing is to select those project that will maximize the total net present value. This is the key point that you should keep it in mind. Within the given the limit on the capital budget that you have it. So we are given here some projects with all required return of 4%. Project 1, 2, 3. Okay. Oh, sorry. 3, 4, 5. This is the investment cost. NPV. This is profitability index, and IRR is given here. Which project, if any, should be selected if the capital budget is $100 or 100 million? Which project would you select? Project 1, if your budget is 100 million. Project
So-
1, 2, 3, 4.
We should choose the one that has higher IRR.
No, we should select the one that has got highest NPV.
Then number 3.
But you should pay attention to your budget. Your budget is 100 million. Which project?
First,
Why?
because of our budget is limited by 100
Yes,
million.
because your budget is limited to 100. You cannot spend more than you have it. Less than you have it, okay? Then if you have it 200.
5. The 5th one.
Be careful.
No, the first, because NPV is higher and the initial outlay is less.
So we still confirmed with the project 1 because it gives you higher NPV if you compare with this.
And at the same time, it requires less to invest.
Yes, you can do this project twice at the same time. Now, if you had $300,
Also 1.
be careful.
2.
You can do 1, you can do 2. Projects are not mutually exclusive.
NPV is good for the second one.
For second one. But what if I do 1 and 5? Can I do with my budget? Is it enough?
Yeah.
So Do I get higher NPV if I get only 2?
Yes.
So my decision will be project 1 and 5, yes?
Yes, yes.
What if the $400 you have it?
1 and 2.
What if you have 300 million, but we will do first project 3 times? I mean, NPVs will be higher. No.
No. NPV, like you have to repeat it.
Yeah.
At the same time, you can do it, but whether the resources will be enough for the same project. But we have to select with the given projects. Actually, that is the really good question that you asked. It could be done in this way. But the issue is that will be there any demand for it? Like, let's say you're opening car manufacturing in Kazakhstan and you want to repeat it. So do you think that will it be logical in the same city to open the second car manufacturer factory? You open one company for 100 million, okay? And that gives you the NPV of 20 million. This is project about the car manufacturing. You're opening in Almaty. But you're opening in Almaty factory, but it doesn't mean that you will just supply in Almaty. The supply of the car will go to other cities as well, isn't it? So do you think that it would go if you open it 100 million again, same project, that it would work? Do you think so? And repeat
No.
this again.
But what if we open in different cities?
Okay, open. How many car manufacturing we have here in Kazakhstan?
I don't know.
2 car manufacturers. One is in Pavlodar, the other one is in Kostanay. Do we have any problems in lack of the cars in Kazakhstan?
No.
I guess
No.
no.
Is there any problem with do you have it if you have money now? Do you have any problem that you will not find a car?
No.
So based on population?
Yes, based on demand. Based on the demand. There is no guarantee that if you establish this company, this factory, that it will work same as it worked in the beginning. So it should be based on the demand. You should do more market. You cannot, let's say you open in Almaty one project, okay, project A, it's a factory. You cannot do the same project in Almaty again because the people already getting the things from here. Why they should buy it here? The similar. So that means you can create for your own self a competition, which will reduce your profit. So that's why this could be one of the reasons. It's better not to repeat the project. You should repeat if there is a demand for it. Like educational agency, I'm giving some language services to the people, like English, Turkish, Spanish, Arabic, any other languages in Almaty, in one region, let's say Medev region. And I want to move to the Bastandik region to open the same company. That would be the possible. That would be the possible. If in the second region there is no such a thing. So you have to investigate, you have to do this marketing research, whether there is such a company already or not. Have you heard about the Student Mobile Center in Atakent, where only the mobiles are selling?
Yeah.
Yep.
I know
So
about
do you think that if you go and open a small shop there of the mobiles and you will be the successful in it?
No.
I guess no.
Why?
Because of the price. the price is smaller than all the other
Everywhere.
shops.
Because
Competition.
concurrency, what is
Competition.
Competition. Competition. So because of the competition, there will be many of similar to you. Then what is the reason for you to so to do a business, you have to be unique. You have to come up with a unique product when there is a demand for it. This is the case actually. Okay, what if you have $400? Which project would you select?
we can get
1 and 2.
2 and 1.
2 and 1. In total, you get
50 as opposed to 40.
2 and 1. Yes? In total, you get 50 million of MPV. We cannot get to 5 and 1. Yes? It gives you only 35.
Can we get first project 4 times?
Yes, you can do it. But will it work?
Like MPV will be high, right?
Yeah, MPV will be high. Surely it will be high. There is no doubt on that. But is there any guarantee that your MPV will be realized, that you will get that MPV? Okay, from the first project, you can get it. But what about the second, repeating the same project? Do you have any ideas? What do you have any business ideas in your mind that you want to do? Real business. Who was speaking?
Me, Jangir.
Jangir. Do you have any idea, any businesses that you want to do in the future?
Actually, right now I don't have, but maybe it's like the thing that connected with like restaurants or like
Okay, restaurant. Which type of restaurant? Kitchen? European, Middle East kitchen, Kazakh kitchen, which kitchen?
I guess Kazakh kitchen, like
Kazakh
Navat one.
kitchen. Okay, we agreed. Okay, just a second, because I want you to understand it properly. Map of Kazakhstan. Okay, where would you want to do this? Which city?
Almaty.
Just a second. Here, the Almaty Oblast is here, yes, the region, as we can see here. Yes?
Yeah. Yes.
You want to do it here. The Almaty is not that big. It is this part, yes?
Right.
So where you want to do it? You said 4 times you want to repeat. So it means that 4 restaurants you need to open. Do you think that these 4 restaurants will work in Almaty, the restaurant that you are offering?
Ah,
It's better to open it in other countries or in other
Cities, yes. Do you think that at the same time, will you be able to do it? Opening here, opening here, opening here, and here, and here. Will you have this power and time to do it?
I guess no.
So that's what the reason. First of all, you need to do investigation in all cities, because cash flow projection, for example, when you do the cash flow projection, for example, this project 1, you do it for one specific region, for one specific industry. And you cannot assume that all regions are same, because the people who live in Shymkent and people who are living in Kostanay, they are totally different in terms of eating, in terms of even they are living in the same country. Imagine if people who are from different culture, I'm talking about the same nationality, in the same country, they are different in terms of language, a big change in the languages, preferences, and so on. So you have to make this investigation. It's not easy. This project is conducted only for one region, for one industry, like one segment.
May I ask one question?
Yes, sure.
When we're talking about the different districts in our city, it's also the different demand and also different NPV, isn't it?
Yes, very true. Very true. Because I might consider, for example, when I do the cash flow projections, how many units I'm going to sell, how many services I'm going to sell, I'm doing according to the demand. If population in the Almaty 4 million, I don't assume that all this 4 million will consume from me. I am assume maybe 100,000 of people from certain region, let's say this district, this small part, let's say this small part that will try to capture my market share. I cannot say that the whole Almaty will be mine. So I'm just considering on this small part on the demand, because when you do the cash flow projections, this cash flow projections is based on demand. Who is going to buy your goods or services? That will create the sales. You're making some projection. For example, for the university, can we say that Kimep University will get all of the graduates from the high school next year?
No.
No, definitely. One can come and say, okay, I want to open Kimep here. I want to open Kimep in other, in Bostanlık region. I want to open the Kimep in, what do you call it? In Awezef region. I want to open the Kimep in all of the districts in Almaty. Would it be logical?
We will lose our uniqueness.
You will lose your uniqueness. You will lose your strategy. You will not make any profit. You will be just bankrupt. Like it's not like when you say I want to repeat the project. This is what it means. Kimep, one place. Kimep, another place. Like a Kimep, a small branch. Okay, talking about the branch restaurants is totally different. Again, still you have to do the marketing research. The cash flow projection is not the same for all districts. So one project, one segment, one industry, one place. Does it make sense?
Yeah.
Okay. So $400, we will select, we set project 1 and 2. Yes? For this, because it gives you the highest NPV. We cannot select this one because it's only 40. We cannot select 1 and 5. It gives you 35, and the highest only gives you 1 and 2. We said. What if 500?
1 and 3.
1 and 3. Because it gives you
60 NPV.
What if you select 2 and 5?
Only 45.
Only 45. So we select 1 and 3.
Excuse me, in this case, IRR make a case or not?
No, we know that the IRR, it's giving you some pitfalls. IRR doesn't give you that much. Even though you can try to compare the IRR as well. Compare the IRR. You will select the highest IRR. This is the highest one. And this is the highest. Almost highest. You could select 3. You could select 2, project 2, but the NPV is smaller for 2 than the project for 3. So we are concerned more about money. NPV is all about the money. However, in Kazakhstan, most of the investment appraisal projects like cash flow projections are doing this IRR rather than NPV. Okay, we could ask this question, why they are doing so from Mr. Talgat when he comes with the presentation. Why the small firms, they prefer IRR instead of NPV. But NPV is the best investment criteria that doesn't have any pitfalls as P profitability index and as IRR as payback rule. But in Europe, in other countries, NPV is mostly used. My opinion, why the IRR is used more in here in the Kazakhstan is because of maybe simplicity. Like it is simple to interpret and it is simple to calculate. Easy to understand, like internal rate of return, like return from internal sources.
Less sophisticated.
Yeah, less sophisticated, we can say that. So this is what we have been doing it, okay? If 101, 200, if 501 and 3, this is how we get the NPV. So to maximize the total net present value for any given budget. So capital rationing, there's a hard capital rationing occurs when the funds allocated to managers under the capital budgeting cannot be changed at all. And there's a soft capital rationing occurs when the managers are allowed to make some changes to their allocated capital budget. If they can, of course, justify their top management, that additional fund will increase the shareholder value. So if your budget is 500 and you think that if you add one more project, that will really gives you some benefit, and you have to convince the top management to increase the budget level, Okay, I think then we are coming to the risk analysis. This is the part that I wanted to start Monday, not Monday, yeah, Monday. We're gonna have the class. We're gonna go through it. By the way, have you ever some of you participated in CFA challenge competition?
No.
No, like every year, there is a CFA challenge competition that is organized by the CFA committee from the Europe, and the KIMEP is participating in that. So this, if you study this good, like special sensitivity, scenario, and simulation analysis, I mean the risk analysis itself, plus this whatever you have seen up to now, this will contribute a lot to solve the questions that comes in that competition. Just for your information, keep in mind when you will be invited for CFA competition challenge, then just be sure that and go, you can do the work.
Excuse me, Alimshan.
Yes.
Are we going to study Sharpe ratio?
What's
Sharpe ratio.
Sharpe ratio?
Yeah.
No. It's not. It's from from the investment course, but in here it's more related to the cash flow projection estimation. We're not going to
got it.
Okay.
Mm-hmm.
Okay. I'm done for today, and I wanted to give you an activity. Let me not to give you. Okay, I don't want to overload because we've got 7 minutes. But during the 7 minutes, I will take the attendance.
So we don't have an activity, yeah?
Yes, we don't have any activity today then. I was planning to give you, but I'll give you the next time. So Rinat is here. Rinat, not. Ablayhan, he was here, I think. No. Camila. Okay. Temirlan, Tayrbek.
Here.
Azamat.
Here.
Okay. Olesa. Gani. Alexander. Park Yunjun.
Yes, I'm here.
Okay. Alibek is here. Nariman.
I'm here, Professor.
Okay. Marlene.
Здесь.
Rustem,
Здесь.
Jangir.
Alicia, I'm here.
Okay, Jangir,
Here.
Vladislav.
I'm also here.
Okay, Azamat, Umirjanov.
Половина
Professor, I'm
нету, да?
here.
Who is
Azamat.
Azamat? Azamat,
Yes, yes.
okay. I just wait. 1, 2, 5 people is okay. But why 5? There is somebody else. 5. So I should have in the class. Rinat is here. No. Ablayhan. Very strange. Okay. Camila.
Sir, can we go if we might
Yes,
continue?
those names that I called. Gani.
Very strange because there is people who not in list. I see.
Okay, in our course, maybe the people who are not in the list, that might be the reason. Is there anyone who is not in this class? Please just raise your voice. Otherwise, I'm trying to find out whether somebody I missed.
I see Amangul Niyaza, but she
She's not
is
in
not
the
in
list.
this. Yeah.
Okay, she's the spy.
yeah, she is a spy.
So, okay, maybe FBI, Special Forces. Anyway. Okay, guys,
Goodbye, Professor.
take care. See you on Monday then.
Have a good day.
Thank you, Professor. Bye.
Bye, take care.